Well, it's going exactly as we had expected. The tramming loop was finished on time and slightly under budget in June this year. That means we can just move more material underground. The number 6 wind shaft, that was finished again as expected in July. We're now equipping that shaft, and we'll start horizontal development into the ore bodies anytime now, with a view to commencing production in January next year. So that's going exactly as we expected it to. Not from a group perspective. The Blanket's investment plans were predicated on a gold price of 1,200, and so given the fact that the gold price has come down a little bit, Caledonia will be injecting about $5 million back into Blanket, so that Blanket's got the financial capacity to continue to implement the investment programme. That still leaves Caledonia with plenty of cash on its balance sheet, and it protects Blanket down to a gold price of about $10.50. So if the gold price goes down to $10.50, having re-injected $5 million, Blanket can still fully implement the revised investment plan. So that's one of the reasons why we keep so much cash on the balance sheet. Well, it's a volume game, and we've seen that. Good months, the costs come down; bad months, the costs go up, because the fixed cost base is quite high. So the production profile for next year is, broadly speaking, about 11,000 ounces in Q1, 12, 13, then 14,000 ounces in Q4. And as we increase that production, we'd expect the on-mine cost to fall from approximately $700 an ounce, which is pretty much where it is at the moment, to say just over $600 an ounce by the end of the year. So quarter on quarter, you should see falling on-mine costs and also falling all-in sustaining costs as the group overhead is also spread over more ounces. From January next year, January 2016, small incremental production coming out of the number 6 winds, only 10 tonnes a day initially, then increasing sort of month on month after that. But as I say, that does have a very significant effect. Even modest increases in production have a very significant effect on our cash generation. Yeah, we're continuing to do work on those projects. We kind of ask if there's sort of a bit of a balancing item. So as we feel, if the gold price rises and we feel we've got more cash, we put more money into them. If the gold price falls and we've got less cash, we put less money into them. But we're getting to the point now where we feel that we need to invest in a pilot plant, about $1.5 million to go into a pilot plant, to prove up the large-scale metallurgical processing. So that actually we will know if that works, whether we can proceed to move forwards with full-scale commercial production. I think that's the next step. Had the gold price stayed higher, we'd have had no difficulty funding that. That's not part of the. That's not included in the current sort of capex budget. So it would have been an optional extra, a nice to have. Clearly, as the gold price has come down, we're not in a position to do that currently. But we're working on funding mechanisms, because we really need this pilot plant to know if we're going to continue with these projects or not. Yeah, so the current gold price, I mean, you'll have seen that we recently paid the October quarterly dividend, and provided the gold price stays within a reasonably sensible range, we've every intention of maintaining the quarterly dividend. We understand it's important to shareholders. They also regard it as an important discipline for management, and so as far as possible we intend to maintain the dividend. Clearly we're not going to guarantee the dividend. If you want a guaranteed return, try your luck with government bonds or a bank deposit account, but within the realms of ordinary gold price movements, we do intend to maintain that dividend.